additional monies had started coming into India due to inclusion of JPM bond index, which is due in June. So how is it going to impact the yields? Has it started to happen, the impact on yields? And how will it impact the fixed income funds? And is there any change that you have started taking, as in UTI mutual fund has started taking into its fixed income funds, considering this?
So in the near term, it results in flattening of the yield curve because typically when you see flows across the 5, 7, 10, 14-year space compared to the natural demand, it results in compression of term premia. So the typical term premia which we used to see between, let's say, the repo rate and the 10-year yield or the 5-year yield, that may compress in the near term. Ultimately, in the longer term, what matters for term premia is inflation expectations and expectations of a predictable monetary policy. So while in the near term, we do believe that till we see the whole of flows to come in, we may see a flatter yield curve. But ultimately, what will really shape the yield curve is the expectations from monetary policy, is expectations of a stable inflation, which will really drive, the yield curve. So, for example, if you see the US, where the curve is inverted, the curve is inverted because the expectations are that the near-term inflation will soon dissipate, and the long-term inflation is still will be moderately lower. So I think once the expectations start to build in that inflation is likely to well behave in India, we are also likely to see a flatter yield curves than we have seen. From FPI flows perspective, we believe it's overall structurally it changes the demand supply dynamics for India at least for the next 2-3 years. So typically, especially post-COVID world, the bond market has relied on RBI OMO to fulfill the demand supply gap between the government borrowing and the requirements of the banking plus the insurance plus the pension and the mutual funds. But there was always a gap. So with this bond inflows coming in, that gap gets fulfilled. And it also places an additional burden of responsibility on RBI to be more external looking as well. So till now, RBI was more internal looking. And of course, their overall conduct of monetary policy will be towards domestic considerations, but they cannot be very outlier to the rest of the world, given that now we are part of the index and the flows in the currency movement may also take cues from how our monetary policy is behaving vis-a-vis the rest of the world.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.